So moving forward to the next item we have here would be for short-term financing. So in case that we do not have enough current assets, we need to manage our current liabilities because working capital, net working capital is composed of two items like current asset and current liabilities. So to maintain a minimum amount of working capital, we need to have a current asset as low as possible and a current liability which is as high as possible. Again, we need to maintain our current liabilities at such point where we can delay payment to our current liabilities without hurting our credit rating from those who extend free credit to us. Now, what are the sources of short-term financing? We have spontaneous sources, which is composed of accounts payable and accrued expense. These are sources that are a result of cyclical transactions of the business with suppliers. So these are they are spontaneous because they are part of our operations. We incur them naturally, and they're actually source of free credit. That's why we need to maximize the usage of spontaneous credit because they are free credit. You do not have to pay interest to them, so we need to pay them as late as possible, but within still the allowable period. While non-spontaneous source of credit would be the source of short-term financing that is actually planned out, that is actually something in which we put our effort into so that we can obtain financing for the organization. That can be loans, factoring and pledging of receivables, liens, money market placements. So let's answer a series of problems regarding short-term financing or sourcing out short-term funds. For this one, revolving credit agreement. What is a revolving credit agreement? This is a type of agreement or loan facility with a bank, wherein you have where you have an assured amount that is ready to be loaned out to you whenever. So a company has 2 million revolving credit agreement with a bank. Its average borrowing under the agreement for the past year was 1.5 million. The bank charges a commitment fee of 1%. The nominal rate used on used fund is 12%. Determine the effective cost of the revolving credit agreement. So in here, we need to consider first the interest. So that is 1.5 million multiplied by 12%. We have 1.5 million times 0.12. We have 180,000. And also, we have to consider the commitment fee. What is this commitment fee? Of course, the bank held on to the 2 million. They made that 2 million readily available to you during the year, but you have not availed that 500,000. So that 500,000 would have a commitment charge of 1%. So that is 500,000 multiplied by 0.01, 5,000. So 185,000 would be the total cost that you will incur as a result of this revolving credit agreement. We divide that by the amount that we receive from this revolving credit agreement, which is 1.5 million. That would be your effective cost. That is 185 divided by 1.5 million. That is 12.33%. Next, we have our problem regarding factoring of receivables. So what happens when we factor receivables? We actually sell these receivables to a third party so that they would be the ones collecting and they would give us a certain amount of the proceeds of these receivables. the thing is, we need the money now, yet we are still unable to collect from our customers. So they will be the ones collecting on our behalf, and then they would give us money right there and then, even before they have collected it. So the risk passes on to them. They should be the ones collecting. If they have not collected from these customers, then they have no recourse from you. A firm often factors its accounts receivable. Its finance company requires a 6% reserve and charges a 1.4% commission on the amount of the receivables. The remaining amount to be advanced is further reduced by an annual interest charge of 15%. What proceeds, rounded off to the nearest peso, will the firm receive from the finance company at the time a 100,000 account during 60 days is factored? So the account is 100,000. The receivable is 100,000. Now we consider the reserve, that is 100,000 times 6%. That is 6,000, and then we have our commission, which is 100,000 times 1.4%, so that is 1,400. So we deduct those. That is 100,000 minus 7,400, that is 92,600. Then on this 92,600, we would consider the interest charge. Now the interest charge would be 15%, 92,600 multiplied by 15% multiplied by 60 over 360. So that is 92,600 times 0.15 times 60 divided by 360. We have 2,315. So 92,600 deduct 2,315 rather. The answer would be 90,285. So that would be the proceeds of this of the receivables that we have factored. Now we proceed with the next item in our short-term liabilities. We have, assuming a 360-day year, the current price of a 100 peso treasury bill due in 180 days on a 6% discount basis would be, so it is pretty simple. We would get the interest of this 100 peso treasury bill. That is 100 multiplied by 6% multiplied by 180 over 360. You would get 3. Then you would deduct that with the 100 pesos, that is current price of the treasury bill. So 100 minus 3, you would have 97. That'd be your answer. Let's move to the next item in our problems. We have cost of giving up cash discount. Actually, when our suppliers provide us with free credit, we need to maximize that in such a way that we must pay at the last day of the term. However, when they introduce cash discount, actually you are actually being enticed to pay at a lower amount than what is written on the what is the invoice price. Now, should we take or should we not take a cash discount? The thing is, on the onset, we might consider that we need to take it because it's free credit. But alternatively, we must consider that whatever amount we pay on this might be used for something better. Or for example, if for example the cost of giving up cash discount is lower than the amount that will be generated on that period as a result of paying later than the discount term, then we must not get the cash discount and we must resort to paying on the last day of the term without discount. Okay, let's now answer this problem. If a firm purchases raw materials from its supplier on a 210 net 40 cash discount basis, the equivalent annual interest rate using a 360-day year of foregoing the cash discount and making payment on the 40th day is how much? So, to get that, we have the discount, which is 2% over 1 minus discount, 1 minus 2%, multiplied by the days of the year, 360 divided by the term minus the term with discount, the period with discount. So the difference of these two would be the period without the cash discount, which is the period, extended period to which you can use the money which you should have paid to the supplier. So using this, so we have 2% divided by 98 multiplied by 360, then divided by 30, that is 24.49%. So that would be the cost of giving up this cash discount. So for example, you can obtain on that period of 30 days, you can invest your money at an investment that would earn you, say, 30% per annum. You need to not pay on the discount term. But if on that 30-day period, you can only invest the money in an investment that would earn you, say, 10%, you need to take the cash discount because it would give you a higher return. So it is not automatic that we have a cash discount. We need to take the cash discount immediately. Now let's answer another problem. So this is on issuing a commercial paper. A company has just issued 10 million worth of commercial paper that has a 90-day maturity and sells for 9.85 million. The securities are to be redeemed at par value on its maturity date. Calculate the effective cost of issuing the commercial paper. So the effective cost would be, what would be the interest in here? We have 10 million minus 9.85 million divided by 9.85 million, then multiplied by that is 360 over 90. So that is 10 million minus 9.85 million divided by 9.85 million multiplied by 360 divided by 90. Our effective cost would be 6.09%. So that actually ends our presentation for working capital management. There would actually still be a second part of this video presentation wherein we will answer the contents of the assignment that would be due within the same period. So that would be all.